So, welcome. We'll start with the first session, the global macro session. First, I'll introduce you to Daisy McAndrew, who will be our conference chair for the day, and she will moderate our first panel. We'll have this session, and at the end, we always leave about 10-15 minutes for Q&A. But feel free as well if you have any question during the whole hour to ask. We'll have microphone for you. But hope you find the day useful, and I'll leave it to Daisy.
Gail, thank you very, very much indeed. And can I just say how impressed I am to see so many of you here. You've battled through the beast from the east, and it hasn't defeated you. And also, of course, that our panel have done the same. And I think, just to echo what Gail was saying, we really do want this to be a two-way conversation, not just you being talked at from the stage, particularly given that you've made such an effort to be here. So I will be opening up every session that I'm moderating to questions. But as Gail said, if there's something that you really want to add to, disagree with, agree with, whatever it is, throughout, during our conversations with the panel, then please do stick your hand up and we'll get a microphone to you as quickly as we can. As Gail said, my name is Daisy McAndrew. My day job is a political and financial journalist. I was economics editor for ITV News for a number of years, as well as various other roles. And these days, I sort of pick and choose what I do. I freelance, I do a bit of presenting for Radio 4, a bit of ITV, Channel 5, talk radio, and so on. And delighted to get involved with events like today, because actually it is events like today where I get to understand what's really going on within various industries. And of course, fascinated to hear how you think things are going, whether it's in your own specific area of expertise, the general global markets, the general economy. Obviously, later on, we'll be talking about currencies, commodities, whatever it might be. Just a couple of sort of housekeeping points. We are in two different rooms today. So for the breakout sessions, we'll either be in this room, or if you're choosing to go to one of the other sessions, the other room is just opposite. If you go through where the coffees are, and it's on the other side there. But I'll give you plenty of warning to decide where you want to go for each session. That's plenty for me. Obviously, please make sure that your phones are off. Nothing more embarrassing than a Beyoncé track blaring it out during a particularly pertinent point from one of our speakers. Obviously, and if you do want to tweet or do whatever, that's absolutely fine as well. I'll introduce you to our panel. They really need very little introduction. On the left, of course, Anatole Kaletsi, founding partner and chief economist, Gavekal Research, and many other bows to his, or feathers to his nest, if you like. In the middle, Peter Perkins, partner and global strategist, MRB, and on my right, on your right, my right, Charles Dumas, chief economist, TS Lombard. I think we'll just start with Charles. They're just going to give us sort of, their potted take on how they see things at the moment, and then we'll open it up to a bit of a chat amongst ourselves, and obviously, as I said, open it up to you. Charles, just to kick us off, obviously, on paper, things are looking very good. Every major economy finally moving in the right direction. Are there reasons to be cheerful?
Yes, I think so. I don't see why one should distrust paper too much, and we'll all try to say something rather more profound than perhaps Beyoncé might give you, but on the other hand, she might be more enjoyable. But just to sort of move along into the sort of grind here, the basic point is that we now have three global locomotives, by which I mean countries which are growing on the strength of domestic demand. And those are US and China, which we had before, but of course now increasingly German-centered Europe, which including Scandinavia, Holland, Belgium, Switzerland, Austria, is Germany times 2. In contrast to the run-up to the crisis 10 or 12 years ago, the advances of these countries are not dependent upon debt. They're not debt-fueled growth. So the basic medium-term story is fairly healthy, and particularly the German advance over the 5-year term has a good chance of reducing significantly the savings glut, which has been one of the negative factors in the world economy for the last 15 years. Now, the other thing to say is that monetary policies remain remarkably easy. The long-term US federal funds rate has exceeded inflation by an average of 1.9% over the last 60 years and is now below inflation as it has been for the last several years. And even after the so-called tightening, it is still below inflation. So policy is easy, and the Fed's assessment of what a so-called neutral real Fed funds rate might be will be 75 basis points above inflation. So even by that standard, it's easy. And so we can't say that the Fed is tightening at all, because you can only become tighter if you're tight to start with. And what actually is happening is it is becoming a little less loose. Meantime, of course, the ECB, mostly to protect Italy, is spectacularly easy and is going to have plenty of excuse to stay easy because the inflation rate is being held down by the ascent of the euro, which, of course, is now out of control of the ECB for the same sort of reasons as the Japanese yen got out of control of the Bank of Japan from the middle of 2015 onwards, namely that the huge current account surplus is beginning to dominate the foreign exchanges. And so we have, and of course Japan is very easy, and the British interest rates are very low. And so we have essentially a global monetary ease in a time of rapid economic advance relative to potential and economies that are above potential. And at the same time, of course, we have fiscal stimulus kicking in the United States, in Germany, as from next Monday in Italy. No doubt Monsieur Macron will want to do the same sort of thing in France, because he's got a bitter pill to force down their throats, and a little bit of sugar helps the medicine go down. So we're sitting in a situation which is absolutely primed for certainly booming stock markets, and I would say quite possibly a bubble would be the big risk. The upside is a big risk. Of course, we had a little shakeout at the beginning of this month, beginning of last month. I forgot to give anyone a pinch or a punch this morning, but it can be rectified any time before 12 noon. And that shakeout is likely to last several weeks. The previous ones in 2011 with the debt ceiling crisis, 2006, which was a sort of false alarm of the crisis coming later, and indeed the LTCM in 1998. All of those lasted several weeks. They didn't just sort of reverse themselves immediately, and I wouldn't expect this to reverse itself immediately, but the basic thrust is upside, and the basic story is positive, and the biggest risk is actually that too much prolonged central bank ease creates a boom bust, which comes back to bite us sometime late next year.
Sometime next year. Peter, would you agree that things are looking pretty good, but we're in danger of them being too good and bursting?
Well, I mean, I think it's sort of irrefutable that they're good by any standards we've seen in the last 10 or 12 years. And I think, if you just use a simple metric, which is it's probably been since 2006 that as many countries have been growing at a healthy clip as exists today. And as Charles said, it's really everywhere. So, I mean, there's lots of reasons to be optimistic, I think, about the global economy. That's not to say there aren't a number of risks. And I think from an investment standpoint, what's really challenging this year is that we are in the middle of trying to determine whether we are in a secular inflection point, right? And secular inflection points are difficult for investors. They're difficult for the global economy. It looks this year as though there's going to be a fair amount of bumps. So there's a lot of good news, but actually the good news is priced into capital markets, right? So, it's a function of whether you're just looking at the economy by itself or you're looking at it in the context of investment markets. And I think if you think about this, last year was sort of the perfect year because you had, from January 1st, 2017 until December 31st, you had accelerating economic growth globally. optimal for, for risk assets more generally. And bond yields were held down by a number of factors, but first and foremost by the fact that US core inflation was falling. At some point, we're going to run out of acceleration momentum. And it may be coming now, but it's certainly going to come at some point this year. If you just look at PMIs or, the US ISM or something like that, it's going to be weaker at the end of this year than it is today. Unquestionably, they're oscillating series. And the market, whatever we believe about the health of the global economy or not, the markets respond to that kind of signal. And core inflation is going to be higher in the United States. We'll see whether the relationship between, the fact that the economy is growing well above potential is going to bring any inflationary pressures, but there's going to be higher core inflation in the United States this year. We'll see whether it pans out in Europe, but I think the general perception is last year was as good as it gets from both an economic standpoint and from a capital market standpoint, or the economics behind capital markets. It's not going to be as good this year. Now, that doesn't mean it's the end. I tend to agree with Charles that we could wind up having bubble-like conditions, but I don't think they're this year yet, because I think the digestion period this year is we've got to figure out where we're going with inflation, where bond yields and monetary policy are going. And if you look back at history, capital markets tend to struggle when they have to change the underlying, effectively the paradigm they're operating in, and that's the challenge that we face this year. So yeah, the global economy is good, but we should also keep in mind that if you contextualize this back to the very beginning of the cycle, the Fed's goal all along was to push up asset prices starting in 2009 to support economic recovery. And whether you agree or disagree with the approach they used, there's a check mark associated with that. But the associated element is that the capital market cycle was brought forward relative to the underlying economic cycle. And now we have a good economic environment. There are risks, and there are certainly longer-term risks. But we have a good economic environment. But unless you go into bubble territory, you've largely run out of capital market room for asset prices in the United States. The ideal circumstance would be if Europe is able to sort of carry the baton of asset price reflation, alleviating some of the pressure from the United States. But I think it's a fair point to say there's a lot of optimism and complacency today. Obviously, complacency is unjustified at any time, but by the same token, we have to keep in mind that there have been a lot of unusual circumstances, and as we normalize monetary policy and as we all become more comfortable that the economic cycle is more consistent with the way we're accustomed to them being, that as we normalize things, it's going to be revealed that a number of the challenges that we faced the last couple of decades really haven't been effectively dealt with, and those are going to come to the fore the more we normalize. Bubble conditions can exist because asset markets work off of that, but policy normalization is usually a difficult thing to digest, and I think that's what we face in 2018, or the early stages of policy normalization.
Peter, thank you. Aristotle, do you agree with that? Do you think this is we're being over-exuberant?
Yes, well, I'm lucky to have gone last, aren't I? Because much of the heavy lifting has been done for me. Because I agree with everything that's just been said, or nearly everything that's just been said, which puts me in the fortunate position of, I think, not trying to argue against that, but drawing out some of the conclusions. Should I be pressing this? Because mine is green. Oh, now it's green.
Better.
Now it's green. Yeah. So yes, broadly I agree with much of that, but let me put it in a slightly different context. I've actually been a perma-bull since 2009 about the world economy and about equity markets around the world, since quantitative easing and TARP started in the United States, and then this process, of course, spread to the rest of the world, UK a year later, Japan 3 years later, and even the Eurozone finally in 2015 got seriously into monetary expansion and resolving the bank problems, even in countries like Italy. So I've been a perma bull, and for the last 8 years, I've been struggling against tremendous headwinds when I've gone around the world, speaking to clients, not the headwinds of the world economy, but the headwinds of sentiment amongst our clients. In the last 6 months, not surprisingly, given what we've just heard about the world, I've found that those headwinds have disappeared, and everybody now agrees that we're in a strong global environment and a benign, so far benign environment for asset prices. Now, that's very clearly the consensus. And it's very tempting when you have a very strong consensus, like you now have these three people on the panel, to think, well, the consensus is bound to be wrong. As Peter said, it must be fully priced in, and as a market participant, one should become a contrarian. I don't think you want to be a contrarian just for the sake of it. Contrarian thinking is wrong most of the time. Contrarian thinking always seems clever, but usually by definition it's wrong. You want to be a contrarian at turning points in the cycle. You definitely don't want to be a contrarian in the middle of a trend. So I don't think the mere fact that all three of us agree that the world economy is in pretty decent conditions, certainly better conditions than we've seen at any time since the global financial crisis, in itself means that either the global economic cycle is about to turn in the next couple of years, or that the investment environment is going to shift. But it is clearly incumbent on us now to start looking out for risks, at least as analysts, at least from an analytical standpoint, not necessarily yet from an asset allocation standpoint. And here again, I'm afraid to disappoint you. I agree with the previous two speakers that at least from a macroeconomic standpoint, the overwhelming risk now is inflation. It is not deflation. But that in itself, if you think about it, is a very contrarian point of view relative to where people have been, not just for the last 6 months, but the last 10 years. For the last 10 years, the policy-making world, and this is important, but also investment community, has been obsessed with the downside risks to the global economy, with deflation, secular stagnation, weak productivity growth, the inability, apparent inability of monetary policy actually to push inflation up as opposed to get it down. Those risks, I think, are no longer relevant. They may be, as Peter says, relevant in the very long term. They may come back to haunt us in 3, 5, 10 years' time. But for the next year or two, it's the upside risks that I think are the serious ones. But paradoxically, because of the very fact that the policy-making community and to a large extent the financial markets, particularly the bond markets, have been so obsessed with deflation risks, that actually means that we're not going to see policy responding to the clear signs of overheating that are beginning to emerge in the US economy. We're not going to see policy responding, at least for the next year or two, in the way that it might have been in the past, because the risk management thinking of central banks around the world, but most importantly of the Fed, is still that we're prepared to take risks on the side of more inflation. That's a much better risk management approach than taking risks with over-tightening and slowing down the economy. Now, what that means, I'll just draw some implications and then I'll stop. What that means, in my view, is that in the US, inflation is the risk. It's not monetary tightening that's the risk over the next couple of years. And that in turn means that the yield curves in the bond market should be steepening rather than flattening. Now, in my view, one of the key indicators of whether there's going to be a shift in the next 12 to 18 months towards a monetary policy as opposed to inflation risk, towards an economic slowdown as opposed to an acceleration and overheating risk, will be whether the yield curves are steepening which would mean that the overheating risk is beginning to be priced into markets in the way that Peter suggests, or whether yield curves are still flattening. And and perhaps the most important reason why I remain bullish about risk assets, at least for the next year or so, after the correction that we've seen over the last few weeks, is that during that correction, you didn't have a steepening of yield curves. You actually had a flattening of yield curves, especially at the long end between the 10-year and the 30 years. And that says to me that the markets, and I wrote a piece about this in somewhat more detail, that the markets are still assuming, the bond market in particular, is still assuming that in the long run, the world is in a deflationary secular stagnation mode. Ironically, as long as that remains the case, it'll be safe to invest in risk assets, because every time you have a correction in equities, as we've seen over the last few weeks, the bond market comes to the rescue by reducing yields at the long term and making equity valuations more sustainable. Once we start having corrections in equity markets, which are accompanied by steeply rising long-term interest rates, not just short-term interest rates, I think it will be time to get really worried about what Peter described, that the growth in the world economy is already over-discounted. I don't think we're there yet. And my final point is that while the US is approaching that late cycle stage, in the rest of the world, the late cycle is still several years ahead. The rest of the world, Japan, Europe, emerging markets, are still in an early to mid-cycle Goldilocks stage, while the US is approaching the late cycle.
Anatol, thank you very much. Very interesting. Well, very interesting points that I'd like to pick up from each of you. Peter, I just wanted to come back to your point about normalisation, and you were sort of implying that the dangers that come with it, that almost, what might be lurking under the rock doesn't get sort of dealt with, that problems don't get dealt with that, with normalisation. Can you just sort of expand on that a little bit?
Well, I mean, I think the first thing is simply that, if you just look at the way the world has worked for 35 years, since 1982, we've had an environment in which we had declining inflation and declining long-term interest rates. So everything in the world has been priced off of this steady decline in interest rates. And, that's either over or it's not over, but either of those two outcomes is an outcome that is going to be more difficult than the environment that we've been operating in. And, I might be more optimistic, or you may be more optimistic about the global economy's ability to handle higher interest rates. But what affects market participants and businesses and everything else is, once you've asymptoted and you start tilting up, it becomes difficult for people to say where they're going from here, right? So are we going to normalize to 4% 10-year Treasury yield, or 5% as we've done in the past, only if secular stagnation, fears start to dissipate? But the problem is the uncertainty associated with what's going to happen, and pricing in a future when you don't know either the cost of capital or a variety of other, how much inflation there's going to be and so forth, that imparts a degree of uncertainty. And we have to keep in mind that we wander the world, and I'm sure that the same things run through your brain. Nobody is quite certain how sensitive the U.S. economy in particular is going to be to rising interest rates. We have our view, we do our analysis, we think it's going to be less sensitive than many other people think, but that's going to be an overarching question. If we get inflationary pressures, people are going to be uncertain at what point the household sector or the corporate sector or even the government sectors start to get hit by rising interest costs. And that's just a challenge. We've been riding a wave for 35 years, and that's behind us now.
And we've spoken not very much so far about policymakers. Obviously, we've talked about the role of central banks and so on, but policymakers, including politicians. I mean, Charles, do you get the impression that they know what they're doing?
Well, I think they probably have an idea of what they're trying to achieve, but unfortunately, what they're trying to achieve is wrong. And for starters, we're dealing with a bunch of central banks that are trying to achieve 2% inflation from countries, as I say, United States, continental Europe and Japan, where the natural rate of inflation right now is 0. And to get there, of course, they have to overheat the economies, and you can't switch overheating off when you get there, so you tend to go through it. I'd like to sort of focus on something slightly different, though, which is that the real interest rate, the real bond yield, has been going up quite a bit. We tend to think that in the first stages of a bond yield upswing, and particularly when it's a real bond yield upswing, that tends to be a situation where it's the economy that is driving the bond market. Then there comes a point where, especially if inflation has come through, the bond market starts to drive the economy and slow it down because the yields have got too high, and that was what Peter was alluding to, and I don't think we've reached that point yet. So the point is it cause and effect switches, and then the association switches. Now, there's been another very important influence on the US Treasury bonds, and that, of course, is Mr. Draghi. The US Treasury yields have been held down to a considerable extent by the Eurozone's monetary policy. And the thing that really has changed over the last year is that Draghi has lost control of the euro. Just as the Japanese, around the middle of 2015, having got the yen down to 125 against the dollar, lost control of the yen because there was a little bit of a flurry in the Chinese stock market, and Mrs. Watanabe got nervous, and they had a huge current account surplus. So all of a sudden, the surpluses that was the only thing left because there was no real confidence anymore in the outflow of capital. Similarly, Draghi really should have declared victory and left the field because he managed to hold the euro down at this artificial rate that is basically protecting Italy for 2 years or so until about the spring of last year. And all of a sudden, of course, the Eurozone has this huge current account surplus, and the euro started to appreciate. Now, once the euro starts to appreciate, you're not, as a German investor, going to go into US Treasuries for 2% yield uplift when you can lose that 2% in the exchanges in 2 weeks. So essentially, it becomes a self-feeding process, which is out of control of the ECB. And if the ECB stays easy, as we think it probably will, or easier than it should, then the economies will overheat and the currency will go up. But if, on the other hand, the ECB becomes less easy, then the currency will go up. So under either scenario, the currency goes up. Now, in that scenario, all of a sudden, the things holding down US yields are weaker. And at that point, the US yield goes up. So if you're looking for how this cycle might end in terms of the sort of growth rate retreating to below trend, not in terms of recession, because we're not expecting that, I would say it's because the euro is going to go up enough to slow the euro, and as a part of that, the US yields will all of a sudden have to go up in order to defend the United States, which is in deficit, you see. Eurozone being in surplus. So the current accounts holding the field are going to be the driving force over the next, have been the driving force really, and are going to continue to be. So that's how we see this cycle shaping up and slowing down. But it hasn't started yet. And
element
take a while.
damned if you do, damned if you don't.
Yeah,
in
no,
some
Draghi's, the Italians, of course, will be the people who lose out from this process when the euro, as the euro goes towards proper valuation, which is probably in the 130, 135 region.
Anatole, I know you wanted to come in on that, and also you were chuckling at the beginning about whether the policymakers know what they're doing. So
Right.
get your thoughts
Yeah,
on that
well,
as
actually,
well.
those are two related things. I was going to come in and disagree with Charles, but actually, he just at the last moment said that much of what he's described about the strengthening of the euro and the weakening of the dollar and Draghi losing control has not yet happened. And that was the point that I was going to make, that actually the strengthening of the euro so far, I think, has actually been welcome to the ECB and to policymakers and actually most of the business and community in Europe. I don't think the euro has strengthened excessively at all. The movement in the exchange rates over the last 2 years, the weakening of the dollar, I think, ironically, has actually been all to do with the tightening in the US rather than anything going on in Europe. Our view, where we have had a contrarian view for the last 3 years, is that the dollar generally tends to weaken when the Fed tightens monetary policy, contrary to what nearly everybody in the markets believed certainly a few years ago, and still a very widespread belief. Certainly, if you read the daily market reports, on Bloomberg or Reuters, it's always the dollar went up because expectations of the next Fed tightening have been moved forward by 3 days, or the dollar went down because people are now expecting that Fed funds will be 10 basis points lower than they were before. In fact, if you look back through history, you find that the dollar, generally speaking, weakens in periods of Fed tightening. And that analytically makes sense, because when the Fed is tightening, especially in the early stages when the Fed begins tightening, it's usually because the returns on capital, the real returns on capital in the US economy have reached a ceiling, and the economy is being deliberately slowed down through monetary policy. And therefore, while the short-term monetary, if you like, hot money capital flows may follow the higher interest rates into the US, the real money investments are moving out of the US into the rest of the world, because the returns on capital in the rest of the world are improving at a time when the returns on capital in the US have stabilized. This is what's happened in every period of Fed tightening since the 1980s, and I think it happened again over the last few years. Now, where I slightly disagree with what Charles was saying is that I think that process, it's not completely over, but the biggest part of that process probably has already occurred. So we've seen a big depreciation of the dollar, about 12% over the last 18 months. And I would be surprised to see another 12% against the euro from here. Maybe it'll weaken by another 3-4% a year over the next couple of years. If that's the case, then the collapse of the dollar scenario, which is definitely a genuine threat, is not likely to turn out to be the biggest problem for the world economy. I think a gentle weakening of the dollar over the next few years against both the euro and the yen is something that certainly both the US can handle and actually would welcome, and also would be perfectly acceptable to European and Japanese policymakers. I don't think Italy, for example, is at all threatened by a euro exchange rate at 125 or 130 or 135. Sure, if it got to 150, that would be a problem, but I don't think it's going to get there.
A couple of comments. I mean, I think the dollar, forget the euro, the dollar matters a lot.
Yeah.
It does look pretty vulnerable. It is oversold. That's not an uncommon thing, to look most vulnerable when you're most oversold. But I think that's a scenario because it does look vulnerable. If you retrace the entire 2014 appreciation of the dollar, I think it's going to be problematic and difficult for the global economy to handle. Let's be clear. The dollar is the single most important price in the world, and if it changes dramatically over a short period of time, it has real economic ramifications. Of course, those reverberate to capital markets. But the corollary, and I think the euro is important because if you're looking for an investment climate that's going to be optimal, what you really want is a firmer dollar in the near term. Forget capital accounts, current accounts, all of that. You want a firmer dollar because the risk, as Anatole mentioned, is rising inflation in the United States. A weaker dollar is going to put upward pressure on bond yields. That's a strain. In fact, the only positive thing you could say about a stronger euro would be it would deter the ECB from starting the rate tightening process, because the world was clamoring for additional stimulus, monetary stimulus from Europe, which we do not need. We don't need that. So if you're looking for an equilibrium outcome, a firmer dollar, or at least a stable dollar, is a crucial variable, because it's going to help prevent or at least cap whatever upside risks there are to bond yields in the United States. And that is, forget the euro, forget European bond yields, whatever. They're all driven off of the Treasury market at the end of the day. That's going to drive things. So, that is a risk. We cannot yet say that the dollar is stable, and there are inherent risks associated with it. I will say one other thing that I think is important, maybe to dispute a little bit what Anatol said about the dollar. The dollar, we would argue, is weak because global trade and global growth is good. So the Fed is usually tightening when things are getting better, and the rest of the world's, benefiting from typically in the past from healthy global growth, U.S. growth. But global trade is, for all intents and purposes, ripping. I mean, obviously Europe is ripping by any standard. It's ripping. Even Italy is ripping. I mean,
I don't know what you mean by ripping.
well,
Right,
let's say,
I was wondering if it was RIP.
yeah, but I mean, Italy's potential GDP
I wouldn't
growth
want to
is
see it going slowly on
no,
that
but I mean,
basis.
Italy's potential growth rate is probably on the order of 0.5% or less. So running at a 1.5% growth rate is, ripping is obviously an exaggeration. But I mean, cyclically, it's in pretty good shape. But the thing is that, if you go back through history, 87 is the crucial year to watch for, even though I don't think we're setting up. But if you remember that, 85, the dollar had been appreciating. We had the Plaza Accord to bring it down. The dollar started plummeting. The Japanese, the Germans, everybody has to start easing. You get disequilibria in the global economy. And the problem is you couldn't stop the dollar rot. And that caused significant problems. By the way, people look at 1987 and think of the 87 crash, 22% in a day. That overlooks the fact that the 10-year Treasury yield rose 300 bips during the course of the year. The equity market was blind to it, but we had a real problem because the dollar was too weak. And we can't, that would be very disruptive if we have that happen today. I hope it won't, and I hope interest rate differentials will help a little
Peter,
bit.
we're talking about what we think will happen. We're not talking about what we think ought to happen or ideally should happen.
I agree.
The reality of the matter is that we're in an upswing of the interest rate cycle. You say forget the euro, but it was the ECB's policy that kept the US bond yields low for so long. And that remains, therefore, the key point. And if I can go back to the question I didn't answer, but Anatol did, which is how competent are these authorities? I would say that the basic point is that the market now does not trust the central banks, whereas previously they did. They don't trust it for the very good reason that for 30 years plus, 37 years now, the FX market's been driven by capital flows. And until the crisis, it was all to do with what's the best place to invest, as Anatol was suggesting. But since the crisis, it's been gaming the central banks, and second-guessing the central banks. And all I'm saying
I
here
know,
is...
Anatol wants to come in,
add something on this competence of policymakers thing, which none of us responded to. I completely agree with Charles about the lack of trust in policymakers, but I would direct it not at central banks, and this is where the real risk to the dollar and incidentally to the pound is. It's not about central banks, it's about governments. If the dollar goes into a free fall, which I think is quite conceivable, sort of 1987 style free fall, it won't be because of the Fed, it will be because of the Trump administration, because of the combination of really exploding budget deficits. Now, I've been a deficit denier for most of the last 10 years, saying deficits don't matter, but actually because deficits don't matter when you're in a deep recession or in secular stagnation. But once you get full employment, deficits do ultimately make a difference. So you've got the combination of really exploding deficits of a kind we've never seen at this stage of the cycle, plus, in addition, in the US, potentially, and this is a policy risk that people have completely forgotten about, a serious move towards protectionism. You're a potential breakup of NAFTA. We're seeing almost every week now new tariffs being introduced on Chinese imports and so on. So that combination, I think, is a very, very dangerous one for the dollar. But let's not forget also where we are here in London. The potential for a free fall in sterling is even more obvious than one for the dollar. Now, of course, there's already been, a big fall in sterling over the last 18 months. It's very undervalued. It is undervalued if there's going to be a reversion to the mean of the last 20 years. But if we're moving into a completely new environment post-Brexit, then sterling is not undervalued, and there's potential for a further big fall in sterling. And a final point, relating this back to the bond markets, everybody's worried about the US bonds, quite rightly for the reasons. But why is nobody worrying about the single worst investment in the world by any conceivable standards, which is the UK gilt market? I mean, the UK gilt market is an accident waiting to happen on a scale that we've not seen, well, certainly since the middle of 2016, when 70% of the world's bonds were on negative yields. But if you think about the UK gilt market, either Brexit turns out to be a disaster, in which case the pound falls and all those other implications, that we've talked about, or Brexit turns out to be success, in which case monetary policy tightens dramatically and gilts are again wiped out. This is the worst investment in the world, long-term gilts.
That's fair.
Well, I'm
fair
delighted that, Angela, I was thinking, how long are we going to get away with not using the words Trump or Brexit, which obviously inevitably we would have to have come around in hands on marriage to get them both in there. But I do want to know, particularly on Brexit, what your predictions are at this stage. I know it's almost impossible to know what's going to happen, but for the purposes of everyone in this room, what your advice would be?
Well, if I had to say what I expect to happen, first I'd start with the fact that I think that Brexit is actually less important than the majority of other people think.
Less important in what way? As in the problems it's going to bring with it?
Well, for example, Anatole alluded quite rightly to the descent of sterling. In the first half of 2016, under the guidance of Mr. George Osborne, the British economy was sporting a current account deficit of 6% of GDP. There really wasn't very much doubt that a significant rebalancing was going to have to happen. If you look at the average real exchange rate on the OECD's relative unit labour cost measure, for the last 20 years till the middle of this decade that we're just getting to the end of, it was 14% higher than in the previous 20 years, from the mid-70s to the mid-90s, and we're now back to the level of the mid-70s to the mid-90s. So I would say that we're back to a level at which the British economy can function, and the sort of gross distortions of massive capital inflows and London making money or hand over fist, and Midlands and the North being essentially out of work or reduced in terms of work, that distortion is being reduced. So in terms of how Brexit might work, presuming that we actually have the good sense to reach some sort of agreement with the EU authorities, which of course is quite a big presumption, I think it's modestly positive for the British economy. But largely because it's putting right something which was artificial in the previous situation. Very
interesting. Peter, Brexit and also Trump's influence financially. Obviously every time the markets have a good day, he takes it as, says it's all because of him and he's completely responsible for any economic benefits.
Brexit, fortunately there's only two parties that don't know what the Brexit strategy is, but I think some sort of a muddle through strategy is inevitable, because I think it's both parties recognize that they haven't come straight with the population about what the economic ramifications are going to be, and they're actually afraid to do so. And the UK is going to have a hard time presenting something to the Europeans. Charles and I were talking beforehand. The Europeans are going to play hardball for a number of reasons, and I think that it's going to take us quite a while to find out how the ground really it settles here. I tend to believe we're going to have a softish kind of thing for a while, simply because the country can't make a decision, and neither can the policymakers. No policymaker wants to stand out there. There are a few, but none none are really going to be willing to risk their political careers on this at this point, I don't think, because the nation is torn. So I think it's a muddle-through scenario, but, I agree. Gilts, it was always this case, even before Brexit, that gilts were a terrible deal because, let's face it, this country cannot accept a prolonged period of disinflation, extremely low growth. It'll be cataclysmic politically. So that's not possible. So you're going to lose money on gilts one way or the other. The only question was which path was going to come out. In terms of the...
Bizarrely, so far you haven't.
Well, so far, yes, remarkably. But so on the U.S. front, look, I think the political risk for the United States is the same that people are quite aware of, and that is, the pressure is building. I have no idea what Mr. Mueller is going to find out or whatever, but the number of smoking guns and little flares is going to continually increase, and the pressure is going to mount. And the fact is that there is no loyal base within the Republican Party. There is no cohesion within the Republican Party. There isn't, frankly, any cohesion within the Democrats either. But the danger is that you have just arbitrary, random policy coming out of the United States, as we saw last night with Trump's statements on gun control. And that's the kind of thing that can cause problems, because at the end of the day, that can undermine confidence in the U.S. dollar. If the global economy continues to motor along, and it won't if the dollar really falls apart, but if the global economy continues to motor along, a chronic deterioration of the U.S. dollar winds up being detrimental. It's sort of the late 1970s thing. So, I think the problem in the U.S. is that Mr. Trump doesn't have a lot of authority, doesn't have any policy directives. The Republican Party doesn't either, but there is no leadership on either side, and we're gonna be. There is no evident leadership in the United States that can step forward and say, this is the path we have to move down. And we're not going to find that at least until 2022. 2020. Sorry, 2020.
As well.
But of course, that lack of obvious successor is the problem we're facing here. That's why Theresa May's still in the job she's in. There's nobody waiting in the wings to take over.
Well, there's another interesting catch-22 when it comes to British politics. We agree at the catch-22 on gilts. If things get worse, then you get inflation. If things get better, you have higher interest rates. Catch-22 politically is that if this government carries on, you have the complete mess that we're in today and the lack of leadership. And if this government doesn't carry on, you have Jeremy Corbyn. So that's a pretty bad catch-22 as well.
Yeah, I think of myself sitting on the left here, actually, yes, rather than being on the right. But yeah.
I'm going fantastic. I've already got a show of hands. How many microphones do we have? I can see there's one. Is it just the one? Oh, we've got two. Fantastic. Well, what I'd like, because I can see there are quite a lot of questions, I'm going to take a cluster of questions all together rather than doing them one by one, so that we can get through more questions more efficiently. So we'll take a couple. If we have a gentleman there that I was chatting to you earlier, and then if you could pass the microphone to the gentleman in front of you, and then we'll take some questions from that side. Sir.
Yes, thanks. Panel, thanks very much for your rendition of comments. And I have really just two questions, which really sort of turns the spotlight onto you a little bit. But I think that the audience would probably be interested to know the answers. And one is that, do you see any downside risk in the large cap markets, the US large cap markets this year? We've had 10% drop in the benchmark S&P, obviously during that late stage in January, early February. But is there a risk of another downturn this year? Maybe let's give it some proximity, maybe a 20% drop from top to bottom. Do you see anything like that coming this year? If so, why? And the other thing is, what is your best investment recommendation for this year? You've told us what you don't like, but let's hear about something that you do specifically like, and include the words buy or sell in it. Yes.
Okay, lovely, thank you. And then the chap in front. Thank you. I've made a note.
I've got a slightly more existential question. It's a question that's been raised at various points. The role of the US dollar as a reserve currency, which is something that arguably the Chinese have always wanted to challenge. Given that there's a lot of uncertainty over policy and the future of the US and the US dollar, are we going to see that issue come to the fore again? And what are the consequences if the US dollar as a reserve currency starts to be challenged?
Lovely. And then there were some hands over, or we can get the microphone to the chap in the front with the blue jacket. And then if we could get the left-hand microphone to the back of the room. There are two gentlemen, yellow tie, and middle of the room. We'll go to the blue jacket now.
Hi, thanks. You've briefly alluded to it, but what about China in your framework? It was touched upon, just generally speaking, the role of China in global trade and global growth. It's grown significantly. The risks vis-a-vis their rebound, their stimulus, and of course the trade spat with the US.
Lovely. Well, let's take those three and then we'll wait for the microphone to get to the top of the room. So obviously we had top tips, buy or sell. The first question about the downside to the US market, dollar reserve currency and China. What would you like to start with?
I'll first of all say chances of a 20% bear market this year, very small. In terms of top tips, I think because the central banks, of course, we're worried about the Trumps and the Mays of this world, but it's the central banks who actually wield power, and they're the ones whose credibility, I think, is gone. So the euro will be very strong indeed. And so I would say probably German market is a sort of natural place to be in this context, although of course you have the problem that it gradually becomes less competitive, but I like the German market. As far as the dollar goes, I've always regarded this whole issue of reserve currency as a bit of a non-issue, and I actually, to be quite frank, couldn't care less what happens to the reserve currency role. When it comes to China, I think our view is that actually the Chinese have a very easy job to do. This is an economy where investment is still 44% of GDP and consumer spending is 39% of GDP. And all they have to do is allow people to become better off. And to stop wasting money. And as a matter of fact, and they've been induced to do this actually more by the fear of debt escalation, which seems to have stopped. We now have an M2 growth rate in the 8 to 8.5% region and a trend real growth rate of about 6 to 6.5 and about 2% inflation. So it actually looks remarkably steady to me for at least a 5-year term. And they're not even seriously overvalued. They say the share of world trade has actually been improving a little bit, having deteriorated quite a lot about 2 or 3 years back. So I think the Chinese are going down the Japanese path of 30, 40 years ago, but they're only at 27% of US incomes now, and the Japanese peaked out at 70 to 80% of US incomes. So, and unless the Chinese do something really stupid, which I don't expect, they can carry on at a good 6% growth rate, more or less, as far as the eye can see.
Peter, are you as laid back as Charles is on those issues?
Well, I'll take those in the same order. The odds of a 20% downturn, I think, are also pretty low, although I think we're going to get another 10 percentage point style downturn later in the year. As a simple rule, when the ISM is falling sharply or PMIs and core inflation is rising, you've got a scissors effect that I think is going to scare the markets for a bit. But I think another ruction is coming. In terms of what I like, look, if bond yields are going to go up, I think, banks in general, I think U.S. banks are well positioned. I think European banks are the price of the asset is still attractive. Whether they're great assets is a different thing, and I think they're going to do well. I think banks in general are the right play in this environment. In terms of the US dollar as a reserve currency, look, I mean, the only people who are in denial about the relative decline of the United States are most people in the United States, right? Everybody else is, I mean, it's painfully obvious to everyone. So that is going to change the world's reserve currency environment. But I think the one word or bit of caution, and I think events this past weekend underscored this. You know, the issue for investors is not whether the dollar is overvalued, undervalued, you like Mr. Trump or not. The issue is, will you put your financial control in the hands of the Chinese legal system or any other system, right? It's not about whether the dollar is worth it or not. All currencies are relative. Either you trust the euro or and the people who adjudicate, let's call it in the UK, do you trust the ECJ to make decisions about your assets? Well, the answer is most people don't seem to want that. Do you trust Mr. Xi, dictator for life, to decide how your financial claims are going to be settled? And the answer is I don't think people are ready to do that yet. So the US dollar is still a default position until something else comes along, but it's losing it's going to steadily be losing its power. So I think it's going to take a while for this to play out. But inevitably, the global monetary system is going to evolve to something quite different than we've been in.
And briefly on China, I'm going to rush you because I know we've got a number of questions and the clock is ticking on me.
I think China's getting lucky right now in the sense that they need to undergo a transition still, I think, away from they've had a big boom in the metals and mining sector over the past 18 months. That was very helpful. But they've also had supportive export activity in the past year, and I think that's greased the wheels a little bit for them. China's very important, but it's mostly important on the downside risk. And I don't think, that's what we saw in 2015 in particular. I don't think that's likely to flare up a lot over the next 12 to 18 months. So yes, they could make a policy mistake. I agree with Charles. Betting on Chinese policy mistakes hasn't been a fruitful proposition. I'm reasonably sanguine, although I think the market has become completely complacent. So that is the one thing that makes me
Anatole.
Okay, quickly. Luckily, disagree. I think we could well see a 20% correction in US equities this year. I wouldn't expect more than that, but 20% seems quite feasible, given that the US equity market has two problems. A, it's in the late cycle stage, but secondly, just more structurally, it's very much dominated by technology stocks, which are extremely expensive on the basis of plausible outcome, not for the next 2 years, but the next 10 or 15 years. These are all monopolies. These are all global monopolies, and it's not plausible that they will remain global monopolies forever. But I think what would lead to the 20% correction, and this is not exactly what people expect, would be strong data rather than weak data. I think we're now in a world where strong data is bearish for the US and weak data is bullish because it extends the cycle. But if we get some very strong data that would be bearish for the US stock market, it would also encourage a rotation out of the technology stocks into value stocks, which tends to happen in a bear market rather than bull market. In terms of investment advice, I agree. Buy banks, Italian banks. Sell, I've already said, gilts. They're basically part of the same trade, but for the reasons that Peter's described, I think banks are attractive, and I think what's going on in Italy is extremely politically driven. Once we have the election out of the way this weekend, I think there's a lot of upside in Italy and in banks in particular. US dollar is a reserve currency. I agree with everything Peter said about the relative decline of the US. Where I would disagree is I think the real challenge as a reserve currency is not from the RMB, although that will emerge over the next 20 years. It's from the euro. And I think the euro actually becomes a much more plausible plausible alternative to the dollar over the next 5-10 years. 3 reasons. 1, the euro crisis is over, at least for the next 5 to 10 years. Secondly, the US, I think, is becoming one of the least reliable jurisdictions in the world in terms of legal and regulatory intervention on wealth. There's been a conscious policy of weaponizing the dollar, as they say in Washington, using it to pursue geopolitical ends, impose sanctions, and so on and so forth, in a way that Europe, I think, will not be doing. So is the Iranian government going to keep money in the US or in Europe? Is the Russian government going to keep money in the US or Europe? I think that's gradually shifting. And finally, I think Brexit could actually be, ironically, a reason why the euro becomes a more credible reserve currency, because by bringing together the question of legal jurisdiction by the ECJ with clearing, which eventually obviously will shift to the Eurozone out of London, and a more integrated Eurozone financial environment, which is less dependent on London, I think would make the euro a more plausible reserve currency. And finally, about China, I agree there is no great risks at the moment. The one thing I would add is that structurally China is slowing down a little at a time, partly for the reasons that Charles gave. Cyclically, last year was a boom year in the first half, and then a significant slowdown. And this year, China is cyclically slowing down further. Now, actually, in the present global environment, that's actually quite a benign influence. The fact that China is weakening a little bit over the next year is taking some of the pressure off commodity prices and energy prices, which is helping to expand the global cycle. And probably by early next year, China will be accelerating again.
Now, I'm going to get in terrible trouble with the next panel because I'm nibbling into their time, but I know we've got questions. Chap with the yellow tie, and then if we could pass the microphone forward to him. Gail, look, I'm getting a death stare from Gail. Oh no, I'm being told that I'm okay. So we'll have the chap with the yellow tie, and then move forward, and then move to the left, and we'll take a couple more. Sir.
You talked a lot about the US curve, the gilts, and so on. One of the biggest drivers has been, of course, the last 30-year decline in the real interest rate, the real nominal kind of R star. Given all the reasons that have been given, and it's very difficult, whether it is the aging population, excess savings, and so on, the two that have been highlighted have been the decline in productivity and the lack of capital spending cycle. Both of those two factors are now turning for most of the advanced economies. Do you expect the R star to go up, and by how much? And what do you think the real impact on the risk market is going to be?
Were you happy with that? So productivity, risk. Lovely. Thank you, sir. Yes.
Question about what makes American inflation special. Why do we have a nascent inflation scare in America, whereas we don't have any sign of inflation in Canada, Sweden, Germany, Netherlands, Japan, Australia, etc., all of which are also booming economies, but no sign of inflation there. So what makes a US inflation story special?
Excellent. And then chap with the red or pink tie. And then I think there was somebody over on the right as well, wasn't there? Oh, great. If we could get the second microphone to that gentleman.
Question on the real economy, particularly the US again. How does the panel evaluate the possibility of a productivity shock in the US? Because it seems to me that it's the one thing that nobody's really talking about at the moment. And there's a really interesting combination of push and pull factors. The push is obviously tight labour markets. Pull is tax cuts, availability of technology, availability of finance, etc., and even the much maligned deregulation agenda of the current president. So productivity shock in the US.
Lovely.
Yeah, and just a sort of simple one, really. We've spoken a little bit about rates, a lot about rates in the US and gilts, but when we talk about real rates in the Eurozone, can you actually make a plausibly bullish case? Is there any bullish case for Eurozone rates over here?
Great. I think I might squeeze one more in, and then I'm probably going to have to make it. I thought there was somebody else who was bursting. No, well, that's perfect. Excellent. So we've got 4 questions to answer there. Productivity in the risk market, American inflation, productivity shock, push and pull in the States again, and then Eurozone rates. Anatole, we'll start with you.
Okay. So the first question on R star, the so-called equilibrium or perceived equilibrium level of interest rates. It's been falling and it's now very low according to the Fed. It's only, I think, in real terms, something like 1.25% or something like that in real terms. Yes, it will be going up for exactly the reasons you gave. Investment is accelerating, and I think productivity. This also relates to the question about the productivity shock. I think productivity in the US is going to turn out to be growing more rapidly than expected. The slowdown in productivity over the last 10 years has been, in my view, very largely a cyclical phenomenon due to the lack of demand. It hasn't been due to the lack of technological innovation or the lack of entrepreneurship or whatever all over the world. So I think productivity is going to start rising as the economy accelerates. That should imply a higher level of equilibrium real interest rates. In the long term, that will push interest rates, market interest rates and bond yields will up. But crucially, going back to what I was saying earlier, because the central banks still believe that R star is very low as a result of their backward-looking analysis, and because that analysis is shared by the bond markets, in fact, the bond markets believe in secular stagnation even more strongly than the central banks do. What it means is that market interest rates will not rise towards the equilibrium level of interest rates for quite a long time, which in turn means that this economic cycle will continue until it leads to overheating. That relates to the inflation scare. Why is that only an inflation scare in the US? Well, because the US really matters, and so we all look at it and we're concerned about, so far inflation hasn't really picked up in the US, but for all these reasons we're describing, it's likely to pick up. Why it hasn't picked up in Sweden is a real mystery in my mind, and I'd love any views of Scandinavian economists. Why it hasn't picked up in Australia is because Australia is very exposed to the commodity cycle, so you had a big wage inflation in Australia 4 or 5 years ago. It's turned down because of the collapse of iron ore prices, but I would imagine you will get inflation in Australia as well. And finally, real rates in the Eurozone, yes, they will start to rise, but crucially, the Eurozone is about 5 years behind the US in the cycle. So if US rates are only starting to rise now, if inflation is only starting to become a problem in the US today, we're still, if not 5 years, at least 3 or 4 years before we face those same problems in the Eurozone.
Lovely. Peter.
So I'm not sure the order. I mean, the first thing I think is R star, nobody knows. Nobody. As Anatole said, it's a backward-looking exercise. It's a guess. I think the markets are I agree that, the markets are too wedded to the secular stagnation thesis, and central banks are too wedded to the notion that R star is some, amazingly low level. I do think it's going to rise because I think, the central banks and others have mistaken cyclical forces, again, for structural forces, and therefore as cyclical dynamics change, as has happened in every other cycle in the past, secular perspectives will also change, and that'll put some upward pressure on it. In terms of why more inflation in the United States when we don't have it elsewhere, going back to the US cycle is more advanced than everyone else because Europe had a recession in 2011 and 2012. Japan had one. Frankly, the whole global ex-US had one in 2015, I would argue. So I think it's that, but also, we had some idiosyncratic downward pressure on inflation last year in the United States that's starting to unwind. We don't know the relationship between output gaps and inflation any longer, and so there's uncertainty about it. But I think it is inevitable that there will be pressures because demand growth is pretty strong. In terms of productivity growth, again, we don't know a lot. The United States is one of the few countries that had a second wave of accelerating productivity growth in the 1990s. Most other countries have been on downward trends for a long time. I think we're probably going to get a cyclical improvement in productivity. I don't know about a secular one yet, but I think we'll get a cyclical improvement in productivity. And we'll find out that, yes, interest rates are below what is reasonable given the underlying economic conditions, and we'll get some movement towards it. But I agree, central banks are deflation, they see asymmetric risks for deflation, and they're going to run behind that. And I think that's probably the underlying case of, while we may have problems this year, asset markets are more likely to be bubbly than depressed.
Charles,
Yeah.
final word for you.
Yeah, okay. Well, I mean, on the US inflation, if you take away the rental element in US inflation, it's still only just over 1%. But obviously it is relatively late cycle and is likely to be going up. The growth, such as it's been over the last several years, has been heavily concentrated in low-wage labor. And that, of course, has lowered the productivity because these are low-income jobs generating low value. We're now into a major capex cycle, which is liable to raise productivity. So I would be moderately optimistic about that. When it comes to the European side of things, the inflation rate has stayed low. I personally, a few years ago, expected German inflation to maybe be the equilibrating or the rebalancing item in Europe, but the Germans have done something rather interesting, which is to import a large quantity of labor from abroad, whether deliberately or not, I don't know, and therefore they have expanded the human base of their economy and are now going to have to do a lot to make up the shortage of capital that corresponds to that. And so I would expect the savings glut to be very substantially reduced, since half of it is in German-centered Europe. And as a result, therefore, real interest rates the world over are going to be substantially higher, and it will be led by the bond market, which implies a curve steepening, just as Anatole said a little bit earlier, but for slightly different reasons, I think, than he was advancing. But certainly I agree with the other panelists that the central banks are behind the game and, in fact, largely discredited, pursuing targets they shouldn't be pursuing, and they'll do too much too late, and that'll probably be next year sometime.
Well, I think on that note, I'm going to have to draw a close to this session. I'm very, very grateful to the panel for giving us their time and kicking off today's conference so fantastically well. Please show them your appreciation, ladies and gentlemen. So whilst Charles, Peter and Anatole leave the stage, I'm going to hand you over to your next moderator, who will introduce his panel. He's Ian McFarlane, Head of Research at Clear Macro. The next session is on global asset allocation. After this session, we'll break for coffee, but I'll be back to tell you what's going to happen after that. Thank you very much. I'm going to hand over to Ian.